Good morning. This is Larry Ripka, CEO of the Valmark Financial Group. And I finally finished a webcast that I started and stopped at least half dozen times. This morning, I'm going to start this post with a provocative statement that I am sure I will hear about from many of you. I'd like to put forward the proposition that in today's interest rate environment, it is impossible for insurance professionals to act in a client's best interest without access to variable life products. I know this statement will draw comments, especially from agents who have resisted being securities licensed, or from those who think that whole life or IUL is the best product for everyone they meet. Today, I will prove why this statement about VUL is true, both in terms of the current product landscape, but more importantly, looking back at actual results for real existing policyholders, both with general account and separate account products. I'd also like to explain why the drop in yield that has occurred in the last year and a half has made variable life products go from a preferred option to the compelling choice for most consumers in 2021. Life insurance companies are financial intermediaries, and they repackage basic financial instruments like bonds and mortgages for consumers in the policies that we offer. Therefore, it stands to reason that life insurance policies cannot produce yields greater than what they invest in. This precipitous drop in fixed yields must ultimately impact general account policyholders. As evidence of just how much these fixed instruments have dropped, just last week, Alert Rating Services put out an industry snapshot that reported the net investment yield for the 100 largest U.S. life insurance companies had dropped to 3.87% at the end of the first quarter of 2021. This 3.87% represents the total return of everything life insurance companies own in their general account. This impacts what policyholders can expect from every kind of cash value product that is based on the general account. What's more, thoughtful insurance professionals should set expectations that this sub 4% return should be considered more of a ceiling than a floor for general account products going forward. The reason why this 3.87% rate is almost certain to fall further is because new premiums are invested in bonds that yield less than this average. And as existing bonds roll over, they must be invested at these lower rates as well. Life insurance companies are heavily incented by regulation to invest in investment-grade bonds. For example, if a bond drops from BAA, the lowest grade of investment-grade bond, just one notch lower to junk status, the reserving requirements for insurance companies quadruple. As of May 2021, the seasoned BAA bond yielded only 3.65%. And as you can see from the graph, this has fallen almost 150 basis points since the start of 2020. As we consider what kind of bonds insurance companies are actually buying for their portfolio, they're generally investing in both a higher quality and a shorter maturity than this BAA benchmark, resulting in even more downward pressure on the portfolio. So let's bring this back to why it's important for insurance professionals to factor this into a best interest recommendation. It is because the current illustrated dividend scale on whole life and cap rate on IUL illustrations do not factor in future decreases that consumers are likely to see on these products. Mil Todd said, insurance illustrations show a client what might happen if certain undisclosed assumptions prove to be true. If we are to be trusted advisors, we must look past illustrations to the underlying assets that back the products we recommend and not use the highest rate insurance company will let us use to illustrate a particular product. My dad wrote an article 30 years ago called The Ledger Lie that highlighted this very issue. So this problem is not new. In fact, I would argue that today some agents have compounded this problem by picking a product that is even more likely to overpromise benefits with Index Universal Life. And they have tremendously leveraged this flawed assumption with external bank loans. For consumers to do better than sub 4% returns on life insurance cash values, the only legitimate way to accomplish this is with exposure to equities. And the only way to add equity exposure is in the form of variable life products. That is precisely why we started Valmark as a broker-dealer in 1997. Valmark was the first producer group to add a broker-dealer because we recognized to act in clients' best interest, our clients needed access to best-of-breed variable products from multiple insurance companies. Today, this advantage for our member firms is bigger than ever as life insurance companies have been forced to shift their best protection products to a variable life chassis. Today's variable products not only offer consumers better upside than bond-based products, but in most cases, lower guaranteed premiums as well. Andrew Carnegie once said, "The older I grow, I pay less attention to what men say. I just watch what they do." 6 years ago, Valmark created a policy management company to help our firms monitor and manage in-force life policies for their clients. A strategic byproduct of this company is we can look back at the results of thousands of policies our firms have sold over the last 30 years. We have in-force illustrations on all kinds of products with 3 dozen or more life insurance companies. The results are clear. The best recommendation looking backward would have been a well-funded variable policy where the client continued to pay premiums year in and year out, markets up and markets down. As dividend yields have fallen, as cap rates have come down on index products, nothing would have worked better for consumers than a variable policy like this. A personal example is a $3 million policy that I purchased in 2012 as part of a buy-sell funding for our business at Valmark. While at the time, a universal life with guarantees would have been, quote, cheaper than the premium on the variable hybrid products, 9 years later, the actual results demonstrate how the VUL hybrid policy has in fact resulted in a much lower cost of ownership and was the superior choice by any measure. A year and a half, I did one of my first posts, a link that has since drawn more views than anything I've done before or since. It was entitled "The Tale of Two Policyholders." Today, I've updated this post in the accompanying link below. Acting in clients' best interest must be more than a slogan or soundbite. At Valmark, bringing the golden rule to life really does mean offering products that we would buy ourselves. It also means having an honest conversation with clients about what we can reasonably expect from various insurance products and helping clients make better decisions on products that have a better chance of meeting or exceeding their expectations. Thanks for joining me this morning. At Valmark Financial Group, we bring the golden rule to life.